gentlemen, for having me. And my name is Dominic Frisby, and is that working? Yes, here we go. And so today I'm just going to share some thoughts about gold with you. My name's Dominic. I write a newsletter called The Flying Frisbee, which is a combination of unacceptable opinions, market commentary, and stock tips, and you should all sign up. So how to say something original about this incredible metal, about which so much has been said. And I thought I'd start off by just talking about how gold came to be. And nobody really knows. Some people say it was created by God, and other people say that it was the result of supernovae collisions. But we do know that gold was present in the dust which formed the solar system billions and billions of years ago. And gradually that dust accreted to form the planets. We also know that gold is permanent. It doesn't tarnish, you can't change it, you can't destroy it. We all know this. But what that means is that when you touch that little bit of gold around your neck or that little bit of gold on your finger, you are touching something that is exactly the same as it was before the solar system was formed. And I think that's a very profound thought. You are touching eternity, in effect. And human beings first started using gold long before they used any other metal. We found it in riverbeds, little nuggets of gold, and we decorated ourselves with it. We gave it out as reward, little bits of barter, and so on. So in other words, we were using it as a very primitive form of money, and that sparkly stuff captivated us. And this was tens of thousands of years before we discovered smelting and the Bronze Age began. And so I would suggest that we have a primal instinct for gold. In the same way we have an instinct for beauty, we have an instinct for gold. And so I'm minded of this great quote from the stock trader Gerald Loeb: "The desire for gold is the most universal and deeply rooted commercial instinct of the human race." And I think it's that kind of magnitude, gold. It's a very profound thought. And as we all know, gold has maintained its purchasing power over thousands of years. It's not just the gold itself that is permanent, but its purchasing power is permanent. And it buys you as much bread as it did in the Old Testament. There's a reference to Nebuchadnezzar buying 350 loaves of bread for a certain amount of gold. And if you calculate it today, you will find that you can still buy that same 350 loaves of bread. In fact, you can buy more bread for that gold because bread productivity is improved. There are references in the Quran to how much lamb you could buy for a gold dinar, and that rate is pretty much unchanged. The famous one is the Roman toga. You could buy a Roman toga and buy a Savile Row suit for the same price. And similarly, if you look at gold versus oil, you will see that over the last 100 years or so, the price varies, but nothing like as much as the oil price varies in dollars. And similarly, you can go back and look at charts of housing markets and how much gold it took to buy a house 100 or 200 years ago, and you will see that house prices, even with the incredible inflation we've seen in house prices, are largely unchanged. So gold buys you as much food, as much energy, as much clothing, and as much accommodation as it has ever bought you. It's a truly incredible substance. Now, this is a very, very compelling chart. We all know how rampant inflation is and how much less house or anything your money buys you compared to 5 years ago or 10 years ago or 20 years ago. This chart shows consumer prices in the 19th century when the world was on a gold standard. And you can actually see that between 1816, which is when the Napoleonic Wars ended, and 1900, consumer prices fell by 50% over the course of that century. So it really did pay to save, and workers really were rewarded because the money they were paid in bought them more and more and more. And it's just such a contrast to the money system that we enjoy today, where money does not preserve its purchasing power. And I think that's a very compelling chart. And similarly, we look at this chart here, and you can see that over hundreds of years, when gold was official money, how consistent consumer prices were. And then, of course, since we've gone on to the fiat standard, inflation has just been more and more apparent. I'll let you ponder that chart for a moment, and then we'll move on to the next thing. So gold sort of went into a bit of a bear market between 2011 and 2020. Well, let's say 2011 to 2016, if you think about it in US dollars. But this is our glorious British pound priced in gold over the last 20 years. And you can see, because the US dollar was very strong in that 2011 to 2015 period, the pound was actually very weak. And then we had, there were lots of attacks on the currency that followed Brexit and so on. So the pound has been a weak currency. Nothing like as weak as, the Argentine peso or the Turkish lira, but the pound has been a weak currency. And that is gold priced in pounds. And you can see what a fantastically clear trend that is. And you could look at gold priced in yen or gold priced in euros, pretty much any currency in the world, and you would still enjoy the same protection of your purchasing power. Nevertheless, we no longer use gold. Gold is no longer official money. And we use the horse as transport for tens of thousands of years. And yet, with the invention of the motor car, we no longer use the horse. So perhaps gold is as irrelevant to modern finance as the horse is to transport. And I think that is worth pondering. Ben Bernanke referred to gold as a mere tradition. And perhaps gold is a tradition. It's an analog asset. It is the most analog asset that there is. And yet, all the value today in the world is digital. Stocks and shares are recorded digitally. Tech companies enjoy much greater appreciation than companies dealing in the physical economy. You just look at how the NASDAQ has beaten the physical economy over the last 20 or 30 years. Trademarks, intellectual property, even cryptocurrencies. Value today is digital, and gold is the most analog asset there is. So what is the role of gold? Does it really have any role in this digital age? And this is an interesting chart. It shows the hierarchy of financial instruments, and it argues that gold still lies at the top of that pyramid, and that other financial instruments lie below. And what's important to realize in that hierarchy is that gold is a bearer asset. In other words, it requires no third party. I can hand you the gold, my gold, directly to you, and in doing so, I'm handing value directly from one person to another. All those other financial instruments rely on third parties in some kind of way. Now, gold is no longer used as a medium of exchange, but it is still used as a store of wealth. As we've seen, hundreds of investors around the world own gold. They own gold bullion, they own gold ETFs, and so on. But even at an official level, most companies still hold a key portion of their treasury in gold. And this is a table that shows gold holdings around the world. I'm proud to say that the UK now lies in 17th place, behind Uzbekistan and Kazakhstan and Turkey, thanks to that glorious sale by Gordon Brown in 1999. We were once the world's largest gold holder. And the US lies there in first position. And even today, something like 65% of American foreign exchange reserves are held in gold. So even at an official level, countries are still using gold as a store of value, if not as a medium of exchange. But it's that country in 6th position on that list, China. Actually, China says it has 2011 tons. It's slightly upped its holdings, and it keeps increasing its holdings quarter by quarter at the moment. So it's that table is slightly out of date. But even so, China still lies officially just behind Russia in 6th place. But I would argue that, in truth, China's gold holdings are perhaps 10 times higher than they say they are. And in fact, I'm going to demonstrate why in just a moment, that in fact China's gold holdings exceed those of the United States. But the doctrine of China is we must not shine too brightly. And if China were to declare that its gold holdings exceed the United States, that would almost be a declaration of war. And if you look at that central chart where it says, that central column where it says gold holdings percentage, you will see that China's gold holdings are just 3% of its foreign exchange reserves. If China were to increase its holdings to even just 6% or 10% or 20% or 65%, that would be an incredible change to its actual tonnage held. So China's stated gold holdings are 2,011 tons. But China is the world's largest gold producer. It overtook South Africa in, I think, 2007 to become the world's largest gold producer. And it's quite possible to audit the amount of gold that China has produced in that time. And that last year, that figure was 6,800 tons. And then consider the fact that more than 50% of Chinese mining is state-owned. So already, just in terms of what China has produced since the year 2000, that 2011 ton figure looks slightly dubious. But as well as being the world's largest gold producer, China is the world's largest gold importer. And a lot of its imports are broadcast. Its imports via Hong Kong are declared, but other of its imports via Switzerland, Dubai, London, a lot of those imports are not declared. They're private. But you do know that since the Shanghai Gold Exchange was formed in, I think, 2007, over 22,000 tons of gold has passed through the Shanghai Gold Exchange. So 22,000 tons has been imported and withdrawn. We also know that prior to 2000, if you factor in jewellery, domestic mining and official reserves, there were 4,000 tons. So if you cobble those three numbers together, you arrive at a figure of 31,000 tons of gold in China. And I remind you that you are not allowed to export gold. You're allowed to export certain gold products, but domestically mined gold you're not allowed to export. And China's, so you can buy Chinese gold pandas and Chinese jewelry and so on, but so little gold gets exported from China that the figure is negligible. I would also remind you that the People's Bank of China likes to buy 12.5 kilo bars, which are not traded through the Shanghai Gold Exchange. And indeed, the People's Bank of China does not buy its gold through the Shanghai Gold Exchange. So there are other imports going into China that are not going through the Shanghai Gold Exchange. There are also other state bodies that and also the Shanghai Gold Exchange only trades in yuan, so dollar purchases of gold go undeclared. So the point of my saying that is that 31,000 ton figure is likely higher than it says it is. There are also other state bodies in China that own gold. The Army, China's Investment Corp. There are other state corporations. So not all the gold that is owned by the Chinese state is held by the People's Bank of China. So I would argue that China is declaring just as much gold as to be credible. If China said it had bought no gold, then that would just be unbelievable. So it's declaring the minimum amount to be credible, but without ruffling any feathers. Now, I have friends who've worked in China for many years, and we know that China is a very ambitious country, and it was once the dominant country in the world. I once narrated a documentary called When China Ruled the Waves. And it has been the global force, you know, the equivalent of the United States or Rome, a couple of times in its history. And China's, if you were to sum up China's ambition, it wants to regain its rightful place at the top of the world. And part of that is for it to have the global reserve currency. Why is that not going forward? Are you able to help me, anyone? There we go. This is another interesting chart. We'll come back to China in a second, but it shows gold as a percentage of global international reserves. Now, central banks have been increasing their gold holdings since 2007. But what is interesting is that since maybe 2018, 2017, gold holdings as a percentage of their reserves have been increasing. Now, this chart goes all the way back to the Belle Epoque, to the late 1800s. And of course, gold holdings as a percentage of international reserves were much higher back then. But it's very interesting, I think, that in the last 3, 4, 5 years, gold holdings as a percentage of international reserves, not just in China, but everywhere around the world, have increased. And that is the beginning of an upwards trend, I would argue. Now, some of you may have heard of the Shanghai Cooperation Organization, and this is a trading bloc, the mother of all trading blocs. It includes Russia to the north, India to the south, China to the east, and as far as Turkey. Turkey is in dialogue. It's not quite joined yet, but Turkey to the west. 40% of the global population, 20% of global GDP. It is enormous. In terms of land mass, it's the largest organization in the world. And pretty much none of these countries want to be dependent on the US dollar. They are not America's friends, these countries. And what they need, and every time there is a conference, there's this thing called the Russian Davos, the St. Petersburg International Conference that happens every year. And every year, the recurring theme is, we need a system of money that we can use to trade that does not involve the US dollar. And also, you hear all sorts of rumors of currencies being designed. There's a chap called Sergei Glaziev who is apparently in charge of designing a new system of money based on the GDP of all these nations, but that will also involve gold. So this is a big theme, de-dollarization. Now, the big narrative that accompanied the gold bull market of the noughties was the collapse of the US dollar. And that was perhaps a bit extreme, a theme for the mainstream media, even if it did look like it might happen around about 2008. But now the theme is de-dollarization, which is not as extreme a notion as the collapse of the US dollar. And you hear everyone now talking about de-dollarization. Macron was talking about it a couple of weeks ago. Tucker Carlson delivered a monologue about it. Elon Musk is talking about de-dollarization. And of course, all these countries are talking about de-dollarization. But they need a system of money and banking that they can use that does not involve the US dollar. And this is the problem that they're trying to solve. Now, this is a very, I don't know how famous a painting it is, but it was the first cable that was laid under the Atlantic Ocean in the mid-19th century. And it enabled telecommunication, if you like, between the United States and Britain. And whereas previously it had taken 2 weeks to send a message by ship across the Atlantic, now it took 2 minutes to send a message. And this picture there you see is awaiting the reply. So the message has just been sent by, I think, Queen Victoria. And these chaps in the States are awaiting the reply. And very soon after those cables were laid, and that was the great catchphrase, 2 weeks to 2 minutes. And this was like the sort of, in a way, like the internet of the 19th century. And that is why the pound-dollar exchange rate today is called cable. Because within 2 weeks of the first messages being sent, two trusted parties, a trusted party in America, a bank in America, and a bank in London, two parties who trusted each other, broadcast across the Atlantic the first official exchange rate between the US dollar and the pound. And thus is that exchange rate now called cable. Now, in many ways, money is communication. What we use as money is basically defined by the communication technology that is available at the time. And this was a huge breakthrough in communication. And now with the internet and electronic communication, thousands of messages are being sent. Millions, billions of messages are being sent every second involving exchanges of money. But the problem with gold, this analog asset in a digital age, is you can't send gold down a wire. You can't send messages of gold. You still require two trusted third parties. And the problem that this Shanghai Cooperation Organization has is a lot of those guys are allied in their dislike of the United States, but a lot of them also don't trust each other. And in many ways, they trust US banking and the US dollar more than they trust each other, which is why, even though they wouldn't like to, which is why they continue to use it. So what needs to happen is they need to design a system of money and a system of communication whereby they can all trust each other. And believe you me, I'm sure they're working on it, and I'm sure they will come up with something. But I remind you of China's central ambition, which is to top the world. In which case I say this: there has never been in all history a global reserve currency that did not start out backed by gold. They all ended up debasing themselves and abandoning the gold standard one way or another. But to start out, to win the trust in the first place, you've got to back it by gold. So I'm sure whatever currency is being designed by these nations, it's going to involve gold some way. And we've seen how the US has weaponized finance, confiscating Russian forex reserves and so on. If China wanted to weaponize finance, all it has to do is declare its gold holdings, what they really are, and suddenly, and back its yuan with its gold, and that is an incredibly powerful weapon in this conflict between China and the United States, which somehow seems inevitable. America, meanwhile, there is Fort Knox, where American gold is held. America, meanwhile, has not had its gold audited in some 50 years or so on. And there's a joke which I love, which is that the head of security goes to the US president and says, "Mr. President, there's no gold in Fort Knox." And the president says, "What do you mean there's no gold in Fort Knox?" And the head of security says, "There is no gold in Fort Knox." And the president says, "Double the guard." But let's say that gold in Fort Knox actually does exist. And one of the reasons, Jim Sinclair used to argue this, that the function of US gold is for the US to be able to balance its books if it ever needs to. And the US has this incredible debt, which is made possible by the exorbitant privilege of the US dollar. It's made possible by the fact that the dollar is the international reserve currency. But if it loses that status and it had to settle its debt with its gold, you simply divide US debt by the amount of gold that it has, then you arrive at a figure of $100,000 per ounce. It's fantasy numbers, but it's exciting to imagine. As I say, perhaps gold, this substance that has existed since before the solar system and for which we have a basic instinct and which everyone trusts, perhaps it's as irrelevant to modern finance as the horse is to transport. So those are some of my thoughts about gold. I just wanted to talk very briefly about mining in the last couple of minutes that I have. And I'm sure most of you in this room are all either work in the gold mining sector or have invested in gold mining, and it is one of the biggest sources of frustration ever that mining stocks are 2/3 the price that they were in 2020 when gold was last at 2,000. Meanwhile, gold is touching its all-time highs. Why do mining stocks underperform gold? And this chart shows the HUI, which is the index of gold stocks, against gold going all the way back to the late 90s. And you will see that gold miners, there are brief periods when they rally, but basically they have been underperforming gold since 2003, 2004. Now, the reason you're taught to buy gold mining stocks is they give you leverage over the gold price. Well, this chart and most of our portfolios clearly demonstrates that that isn't the case. Now, those of you with long memories will remember that in the 1930s, the number one stock in North America was Homestake, the largest gold miner in North America. But here's the thing. In the 1930s, it was made illegal for Americans to own gold. So the only way they could get exposure to the gold price was by buying Homestake. Whereas now, since the early noughties, we've seen hundreds of ways by which ordinary investors can get exposure to the gold price. There are all the old online bullion dealers, Bullion Vault, Gold Money, Goldcore, and so on. There are the gold ETFs. There are futures, there are leveraged plays on gold, all sorts of ways to own gold. So there has been no need to take on the individual risk of buying gold mining companies because there have been other ways by which you can get the leverage. And I think that explains why gold mining companies have been such perennial underperformers, even the good ones. And as we know, there are lots of gold miners that are crap. But if you look at that action over the last 5, 6, 7, 8, even over the last decade, if you were a chartist, I think you would say that is a bottoming action in process. There's a sort of nice double bottom or even a triple bottom. So while that pattern of underperformance may continue, I would argue that the big pain has already been suffered and been taken. Finally, in my newsletter, I like to tip gold stocks and write about gold stocks. So I'll just share, except for the fact that the thing's not going forward. Can you go forward to the next slide for me? Are you able to do that? It's interesting. I'm keeping you in suspense for my 2 gold mining picks. So here's one of the gold companies I like, Monera Alamos. It has a $174 million Canadian dollar market cap. You can see how awful that chart has been over the last couple of years. And the reason I like that stock is that it's basically morphing from a development play to a producer. It's got its first mine producing late last year, its second mine will be producing later this year, and its third mine will be producing by the end of next year. And my view is that the company will get a re-rating from development play to mid-tier producer, and I've got a target of over $1 on that one. And my other company that I like is called Monita Gold, which has the largest undeveloped gold resource in North America, currently 130 million market cap. Its gold is valued at $7 or $8 an ounce in the gold versus a peer average of $30 to $40 million. And it's likely to be taken out by a major that's looking to replace lost reserves. It's had 12 positive news announcements in the last year, and the stock price has done that. But that resource will likely increase to about 15 million by this time next year. So those are my two gold picks. Very last thing. This is just I tend not to set too much store by cycles because it's quite easy to look at history, find some arbitrary pattern and then declare it a cycle. But nevertheless, if you look at the history of money, you see that every 100 years or so, there is an evolution. So in the early 1600s, we had the first running cash notes, the first paper money. 1716, the first great recoinage. Isaac Newton put the UK on the gold standard. 1816, we had another great recoinage. 1914, beginning of the First World War, we had the beginning of the fiat era. And then here we are in 2014 with these new cryptocurrencies. And I think we can just feel subconsciously that something is going on with money. Nobody understood what fiat money was 15 years ago, and now it's the buzz term. So thank you very much for listening to me, ladies and gents. It's been a real pleasure talking to you, and enjoy the rest of your gold messe, and you should all subscribe to the Flying Frisbee. Thank you very much.